The iPad Pencil coming out? Is that going to help? Well, it certainly may be a little bit related to product launches, but a basic forecast we can do is we can take last year's number and we can multiply it by a growth number. So if we were going to say that it was going to grow by 5%, we multiply by 1.05, and we get 61 billion. And Apple has not shrunk in a long time, is my understanding. Let's take a look at that. And I want to point out that the goal isn't to accurately forecast the revenue number perfectly, and I'll explain why. So you can see Apple has not shrunk in many, 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 many years. Since 2006, and we don't even have data that goes back further than that, 10 years, they've not had one quarter where revenue was lower for that quarter than the year before. For this quarter, you can see that Wall Street is expecting 52 billion in revenue. So not only does Wall Street think it'll be the first quarter in a long time where Apple actually generates less revenue than before. We don't know. Wall Street could be wrong. It could be 56 billion, 58 billion. But certainly Apple's saying something. We'll see what Apple's saying in a minute. But Wall Street thinks it'll be lower than last year for the first time in over 10 years. Crazy. That's so crazy. How about the next quarter after that? They're saying -4, then +1. Well, what if there's a recession? Then that'll affect these numbers too, right? It's hard to say. Let's assume something in the middle. Let's assume it's not as bad as Wall Street thinks, but I also think Wall Street's estimate of a quick recovery is probably too ambitious as well. So, but I don't really know. I'm not a close Apple watcher. I will be after this, as will you. But let's assume that. Okay, let's assume that revenue. Now, how about gross margin? They've been pretty steady at 40%. So unless their costs are changing for their products, I'm going to keep it at 40%. COGS are just the subtraction of those two. How about R&D and SG&A? Well, for Apple, these numbers don't matter that much. They're so small relative to the rest of the business. So I'm just going to take last year's number. Whatever they did last year, I assume they'll do that this year. The rest are all just formulas. Interest expense, interest income. Well, they keep making more and more money on their interest because they keep hoarding all their cash. How about taxes? Well, let's see. Their tax rate has been pretty consistent at 25, 26%. So I'll just do 25%. And now you've got a full forecast for the rest of the year. Now, it's not the most advanced forecast, I admit, but it's a forecast. It means something. And now we can put down an annual forecast. And you'll see the magic start to happen here. Well, first, we can take the sum of, let's do 2016 real quick. All right. So we have them declining by 2% in 2016. Now the question is, what is the long-term growth rate of Apple going to be? This is the trillion-dollar question, quite literally. Will Apple grow their revenue? Will they shrink? What will happen? What do you guys think? Shrink or grow? From here to 2030, shrink or grow? Take a guess. Shrink or grow? Static? That's a good one. Shrink? I think they'll shrink. Will the 2030 revenue number be above or below? Everyone's saying shrink. I think that's what Wall Street thinks. I mean, they have grown a lot. It's hard for them to keep growing. In my understanding of tech, they have reached the top, and most of these companies that reach the top tend to shrink again. Now, having said that, there have been companies like Microsoft and IBM that have sort of had these ups and downs. It's hard to tell. Some people think they might grow. Who knows? And certainly without Steve Jobs, it seems like they might need a miracle, a new product, and it can't cannibalize, right, the iPhone. So iPhone is most of their sales. So we'll see. Let's assume, for argument's sake, that it shrinks by just 1% a year. That's barely shrinking, right? That's barely shrinking. How about margins? We have to guess on their margins. Will they be able to make more money per phone or less money per phone? Well, costs tend to go down over time, but the features tend to go up as well. And if they do get into other businesses like cars and other things like that, who knows? I don't know that margins will go up that much. Remember, other costs go up too, like employment costs. And yep, you're right. It does depend on who's the president. Let's assume that margins are the same. Let's assume that they're the same. I think that's fair. How about their other costs, like research and development and SG&A? If their revenue is going to decline, should we assume their costs decline a little bit too? I think that's only fair. That's only fair. How about interest income? That'll probably keep growing because all the cash they're accumulating. Taxes, will their taxes go up? I don't know, it's hard to say. 25% taxes seems reasonable. So now we've got a long-term forecast for Apple that goes out to 2030. So what do we do with this forecast? What do we do with this forecast? Who gets a gold star? Who gets a gold star in class? How do we take this forecast and make it useful? We got a winner. Got one winner at least. Akil, of course. Got a few people who have the answer here. We have to discount back the cash flows. Exactly. We calculated all the cash flows. These are the cash flows. Cash flow and net income are more or less the same thing. More or less the same thing, especially in a business like this. So we're going to discount the cash flow. But before we do that, we actually have to do, well, let's try this out. Let's try it out. What discount rate do we use? We know that Apple borrows money for 3%. But equity is junior. Equity is junior to debt. So they're paying 3% for the debt. There has to be more than 3% because the debt is less risky always than the equity by definition. So it's got to be a little more than 3%. How about 4? 4%? 5%? 5% sound good? Most equities right now have a discount rate of about 7%. Yeah, it is intro to finance. That's what we're doing. Yep, Finance 101, correct. So I think a little better because we're jumping into investing. All right, so 5%. Let's do 5%. And so if we take this NPV, what do we get? We get $500 billion. That's the value of these cash flows. But remember, the company has net cash. How much net cash does the company have? Well, we have that on the first page. They actually have a bunch of stockpiled cash, and you get that too. That's $160 billion. So the total value is $666 billion. And per share, how many shares do they have? 5 billion. So per share is $120, and the current price is $97. So our calculator is telling us that the shares are worth $120 and the current shares are worth $97, but there's a huge error in this model. What is that error? What is that error for someone who's the expert? What is the error? What is the error? There's a gigantic error in this model. Who can spot it? Who can spot it? Nah. It's a much more fundamental, basic error here. Yes, Brett Larson's got it. No. See if any of the Blab users can get it. I like turtles. Yes, the terminal value. The terminal value is crucial. So remember what the definition. The definition. A company is worth the discounted sum of its cash flows from today until eternity. This model ended in 2030. I don't know about you guys, but I hope to be here after 2030, and I'm sure Apple feels the same way. So I think that ending the company in 2030, that doesn't make sense, right? They're going to be here in 2040 and 2050 and 2060, right? So we got to keep this going. But how do we keep it going? The maturity value, let's say they'll shrink by 2% a year. 2% a year. This is a pretty obvious error, and anyone who got it wrong should be ashamed of themselves. Just kidding, but remember for next time. And you'd be surprised how many advanced financial experts make simple mistakes like this. And they say, in fact, in pharmaceuticals, that's one of the ways that I made a lot of good investments, was to say, well, people don't understand that for instance, patents run out. So in some drug companies, you've got until 2025 or 2030, and then it's over. All your cash flow goes away. In some businesses like Apple, it might last forever. We can't really predict what that forever looks like. So it's a good idea in general to make the maturity value decline every year after maturity. It's pretty unpredictable. It's a good idea to do that. It's a good idea to do that. It doesn't really matter how many years you go out. You go out 100 years. After enough discounting, it's not worth much anyway. So what we do is you take that NPV, we're going to extend it out. You can do this with a mouse or you can do it with the keyboard. I'll just do it for the mouse, just so for pizzazz. And you can see that the value of Apple's actually, according to us, about double. According to our model, it's about double. It's about double where the current stock is 97. And our model is telling us that the stock will be worth $176. $176. So we say terminal value, not term value usually. So why? So why is Apple trading at $97 if our calculation took about an hour? Our calculation is telling us that it's worth double that. Why? Why would it trade for half of that? What do you guys think? Yeah, there's a few reasons. So one is that no, it's not enough buyers. No, it's look at the model. The model is telling you, the model is not wrong. If these things happen, this is a calculation that's as sure as gold. If this happens, it's worth $200, $175. It's because there could be more risk to these numbers than we think. We don't know if this will happen. This is forecasting Apple is going to be a leader in tech for the rest of eternity. That may not happen. That they're going to shrink just slightly. Just slightly. That may not happen. Apple may shrink faster than that. And the risk that we're saying that this will happen is very low. We're saying not only will they be a top player for the next 30 years, but it's very unlikely that anything bad will happen to them. Well, that seems a little generous, so maybe we bump that discount rate to 6%. All right, now it's not as attractive. The per share value is 157 instead of 175. Well, what if we increase that maturity value, decrease it to negative 3%? All right, that chops it down a little bit more. How about negative 4%? How about instead of a discount rate of 6, we say 6.5? Well, you can make this say whatever you want, right? So what value is it? Well, there is value. I'll show you in a second. But let's take that negative 1%. We have them declining by negative 1%. Let's make that negative 2%. What is the NPV now? Oh, it's only $130 per share instead of 97, which is the current stock price. Well, if you told me something is worth 130, and right now it's selling for 97, I'm not that attracted to that. That's only 30% difference. And most people are wrong, especially in stock picking. They're wrong by about 30%. And Christian, you're wrong about you're wrong about that. Net income does equal free cash flow over long periods of time. So I would argue that's a very trivial mistake relative to the terminal value, which is a huge mistake. So anyway, so the question really is, other than these sort of nits and gnats, the question really is, what will happen? How do we forecast accurately? Well, this is hard. You can't learn that in 5 minutes. I showed you in 15, 20, 30 minutes how to forecast the biggest company in the world relatively accurately. I mean, our model is telling us $130 a share. The current stock price is 97. And we can tell that if Apple starts to shrink, it'll be worth probably about where they're at. If they shrink a lot, let's see what happens if they shrink a ton. Let's see if the disaster ensues and Apple starts, I don't know if it's Facebook or Google, but someone just comes in and eats their lunch and just destroys them. What'll happen to Apple? Well, I could see their stock being worth $70. $70. What if they really get decimated? Like next year they drop by 20%. The year after that they drop by 20%. It really starts to get really ugly. Well, then maybe the stock's worth $45 a share. Things would really have to go bad for them. People would just not want to use iPhones anymore. Even if they start to lose money here at some point. We're gonna correct that a little bit. They would put an end to some of their spending if they start to lose money, needless to say. So $60 looks like maybe the worst case scenario for Apple. $60 per share. That's if their business just gets chopped in half very quickly. And the current stock is 97, so $58 would be their kind of, I don't know if it's called a worst case scenario, but a pretty bad scenario for them. But easy come, easy go, right? Who knows? And so we're going to spend a lot of time talking and thinking about, how do we forecast more accurately? And that's a question that, may not be easy to grasp, but it could take many, many years. So we're going to go to the softer side of business. We forecasted one company. We'll do some more. We'll do whatever company people want to do, Tesla or Chipotle or whatever company is fun that people would like.